begin with a disclaimer. So you've heard this all before, but essentially this is just to say that whatever we're saying today is not financial advice. Whatever we always say is not financial advice. All of this is just to teach you a bit about investing, not to give you advice that then you use and then sue us about if you lose money. So yeah, that's basically what this slide is for. Where does what we're going to be talking about today fit into the broader picture of investment? So you've seen this slide or a similar slide before if you've come to our previous sessions. Just as a show of hands, who's come to our previous sessions? Okay, so quite a lot of you, but no worries, obviously, if you haven't, because we'll be covering things again. We'll be covering the basic information that you need for this session. So on the screen behind me, you can see the set of asset classes. And in grey, we have equities. So equities are what we're focusing on today. So as a recap, equities are the same as stocks and are the same as shares. And it means part ownership of a company. So we're going to be looking at companies and valuing companies today. Again, if you've come to our fundamental analysis workshop, you will have seen this slide before. So today, again, we're mostly focusing on fundamental analysis, but we'll also be touching a little bit on technical analysis. The first thing that you need to do before you start investing is you need to have a look at your risk profile, your investment horizon, your goals, and have a look at your portfolio. This is just to see what your current position is and how this affects what your investment style is going to be. This will impact everything that you do from here on. So in particular, what is a risk profile? Does anybody know what this is already? Nobody? Okay, so a risk profile is what you're doing here is you're identifying how much risk you are able to take on. So for example, if you are a parent with 4 children, you have 4 people who are depending on you financially. So your risk profile is not necessarily going to be, you're not going to be able to take as much risk as someone who is single and does not have anyone depending on them and has a fair amount of income coming in. So that is what this is mostly about. But again, it depends on the person. So you don't want to be spending money you don't have, is what this is all about. Portfolio value. So a portfolio value is how much you're willing to spend. Again, this ties into what I was just saying. It's also important to note that if you are just starting up, it's really good to start by using virtual money rather than real money, because if you're using real money whilst you're just practicing and you're just beginning, you're more likely to lose money than make a profit. So now what we will do is we will go into a little bit more detail on different investment strategies. So as you can see behind me, there are 3 main types of strategies: growth, income, and value. What is the difference between all of them? So value is all about finding the intrinsic value of a company. So this is quantitative, and you're finding the value of a company by using a method such as discounted cash flow, which we'll be talking about a little bit later on. Another method is growth. So this is focusing more on the future prospects of a company rather than its current value. So here what we're doing is we're having a look at the percentage increase of the market value and then comparing this to what analysts predict that this will be at the current space in time. Income, on the other hand, is when you are relying on your investments for your income for day to day. So for this profile, what you will be doing is you will have you will be willing to take on a lot less risk because you're relying on this for buying food for your day-to-day income. So we have something exciting coming up. So we have our investing competition, which will be running tomorrow. So we will be giving more information on this tomorrow and letting you know more about this. If you scan this QR code, it links to our Instagram page, whereby you can find out this information tomorrow. It will be going live at 3 p.m. tomorrow. Research. If you are researching a company, if you're researching a stock, there are a few things that you need to do. So number one, you need to look at what you're going to achieve. This relates back to what I was talking about earlier with your risk profile. Number two, we're going to be screening stocks. Three, we're looking into one particular stock further. So we're then using a discounted cash flow analysis and measuring the potential upside. So here we're using discounted cash flow. However, other analysts might use other methods. Then the next step is further research into the company. And then you're creating a research report and deciding whether or not it is a worthy investment or whether it is something you would like to add to your watch list, which is something where you're compiling a list of companies that you think have potential, but you're not invested in just yet. So first of all, we're going to be talking about the first point, which is what are you looking to achieve? So our outlook for today in particular is a longer term horizon. So we're focusing mostly on fundamental analysis, but we're also mentioning a little bit about technical analysis, which I was mentioning earlier. After this, you're going to be looking at whether or not this fits into your portfolio nicely and how it will do this. So CANSLIM analysis. This is one particular method of analysis. So we'll be going into what does CANSLIM stand for, but in particular, it was created by William J. O'Neill, and he was the founder of Investors Business Daily, which is basically the Financial Times, but a while ago. It is a great method for investing, but it is also better if you use it in conjunction with other things. So what does it all stand for? So C stands for current quarterly earnings, A stands for annual earnings, N stands for new, S is supply and demand, L is leader or laggard, and I is institutional sponsorship, and finally M is market direction. So you're probably wondering, what do all of these mean? So C, current quarterly earnings. What this means is you want to be identifying stocks with an earnings per share percentage change greater than 25%. We'll be going into more detail in a minute about what earnings per share, what that is, and what this means when you're screening stocks. You also want a company that is accelerating quarter by quarter. You're looking at the predicted values from other analysts versus what the actual was. Next, we'll be talking about annual earnings. So the annual earnings per share change is greater than 25% for 3 years in a row. This is what you want to have for this to be fulfilled. This is essentially saying that you're wanting long-term growth and you're wanting a company that has been around for a while. N. So N stands for new. This is about maybe the company has a new CEO, maybe they have a new product or a new strategy. These are all important things to be noting when you're looking at a company and how much it can grow. Another important point for this is an economic moat, which we'll be discussing in more detail in a minute. Next, we have supply and demand. So S stands for supply and demand. You all know that as demand is greater than supply, when this is the case, then the price of the share will increase. So what we want is we want a company where the supply is larger than the demand. We also want a leader in the industry. So L stands for leader or laggard. So we're wanting top tier stocks in top tier industries. I stands for institutional sponsorship. So what you're looking at here is you're looking at whether or not other funds are also investing in this company, because these funds make up 75% of all market activity. So if these funds are investing in the company that you think is a good company, then you're going to ride the wave up. M stands for market direction. So this is more about technical analysis. So here you're looking at the direction of the market and working out, well, are you trading with the trend? Because this is important, because then you'll, again, ride the wave up. What to use for your research. So there are lots of different platforms and things you can use, but in particular, the one that we're going to be focusing on today is the Bloomberg Terminal. Another good source is the Financial Times, which is good to be using for keeping yourself up to date with the news. So how to access the Financial Times? The university actually has a free subscription to this, so you can follow the link. We'll be sending this PowerPoint out alongside the newsletter on Sunday, so you'll be able to click on the link, or you can just type it into your phones now if that is easier. I'm not sure whether people are doing that or not. Okay, so the Bloomberg Terminal. This is normally very, very expensive, and a lot of big companies have this. However, luckily for us, the university actually has access to this, and so we can all have access to it as well. Although it's important to note that actually only one person can be accessing this at one particular time. So, for example, if I was accessing it at one time, then no one else would be able to, but then you can sort of, it works out to be that you can use it whenever you need it, really. So how to access the Bloomberg Terminal? So the first thing that you need to do is you need to go to this following link, and then you're signing up as a learner. So here you need to, if you go to this link, it will come up with this. So you need to make sure that you're using your university email address, because otherwise it won't work. Then once you've done this, you will find something like this, obviously with your name in place of my name. And at the top, you can see BMC. So if you click on this, this will take you to the Bloomberg Markets Market Concepts course. This is a really, really good course, and we recommend that you will do this. It will help get your investment knowledge up to scratch, and it's really useful. Also, employers really value it. That's a side note of something you can be doing whilst you're waiting for the university to verify that you're a student, which, speaking of, you would then click on the terminal access, which is circled at the top, and through this, then you sign up as a learner, and then eventually a faculty member at the university will say that you can have an account, and you will receive an email along the lines of this, whereby if you click the link here and then you log in, then it should all work. So again, this is just a summary of everything to do, and when you're accessing it for the first time, there is something you'll need to be downloading, but it's all fairly easy to do as you go along. It's called Citrix Workplace, and that should all work. So, okay, what next? Number 2 is screening for stocks. So the reason why I was talking so much about the Bloomberg Terminal is that's what we're going to be using next in order to screen our stocks. So what is stock screening? Does anybody know what stock screening is?
It's like when you're filtering stocks, you're looking at a lot of them and you're comparing them.
Yeah, exactly. So you're using different criteria to narrow down the options that you have so that then you can have a look and look into more detail rather than looking at thousands of companies. So if you open up your Bloomberg Terminal, then you type in EQS. So with Bloomberg, they have these three-letter abbreviations for words. It used to be the case whereby you could only use the Bloomberg Terminal using these abbreviations, but luckily now you can also just type in equity screening and it will come up with the same thing. But it's nice to know that EQS stands for, is in this case, equity screening. So that would be what you would type into the bar at the top, and then you would click on equity screening. This would come up with the following. So what would you do next? So what you want to do is you want to work out what are the criteria that you want to use in order to screen for stocks. So first of all, what you can do is you can narrow down your search by looking at certain countries. So for example, here you can filter by country of domicile, which in this case, we've chosen the UK and the United States. Next, we can add more criteria. So here, what we're going to do is we're going to be looking at what is earnings per share, because this can be one way of screening for stocks. So we have talked a bit about the different ratios and what these are before, but just as a summary, it's written behind. So earnings per share is abbreviated normally to EPS. And this is what creates a measure to compare companies. What is earnings per share growth? So what we're looking at when we're screening companies in screening stocks in particular is the earnings per share 1 year growth. We have a formula behind us, but what the Bloomberg Terminal is great at is you don't need to be using any of these formulas. It's all done for you. It's just the information that is there for your taking. So what is earnings per share growth? So this is the percentage increase or decrease of earnings per share before extraordinary items. So extraordinary items are something where it is a one-time thing. So it's unlikely to be happening again. And this is abbreviated here as XA. So in particular, when we were looking at CANSLIM analysis, C stands for current quarterly earnings. We were talking about identifying stocks with an EPS percentage change greater than 25%. This is one of the things that we need for CANSLIM to hold. Therefore, when we're looking at screening stocks, this is something we're going to be adding in as one of our criteria. So to do this, we're looking at the earnings per share 1 year growth. So for example, here, what we've done is we've added in the latest quarterly earnings per share 1 year growth, and we've set this greater than 25. And as you can see, there are a lot less matches now, although it's still unreasonable to be looking through 2,095 companies to then work out what you think would be a good one to invest in. So another thing we can look at to further reduce this number is the PE ratio. So again, we've talked about this a little bit before, but there is more information on the slides behind me to summarize this further. So what we want is a PE ratio that is less than 25. Again, it depends on the industry, but here we're using less than 25. Always make sure to do your research into the industry that you're looking into, because you want to compare it to the industry rather than the whole stock exchange. Another thing that you can be considering is net profit margin. So you want, again, this to be greater than the industry level. So In particular, we want roughly it to be greater than 10%. Here, what we're going to be doing is we're going to be considering it above 15%. And something that this is good for is it demonstrates how well the manager is doing at their job. So again, we've added this into the Bloomberg Terminal. Does anyone have any questions so far on how the Bloomberg Terminal is working, or is this all clear? Yeah?
Yeah, you just stated like on ad criteria, you just stating what like the profit margin.
Yeah, so in the ad criteria, as you were saying, you just add that in. It will come up with different ways in which you can different ways that you can limit your limit the ratio that you've chosen to be using. You can also see at the top there's exchanges, sectors, etc., which give you some more options, and they'll often give suggestions. And if you have a look back at this on the side, you've got popular screens. So these are ones where it does it for you already. It gives you an example of one, but you can. It's best to try out different ones and see what you come up with. Also, I'm not saying that this screening that we're doing here is necessarily one you should be using. It's just an example. So we were here. So all of what we're doing here is we're talking about one particular criteria and then how we can implement this into the Bloomberg Terminal as a criteria. So market capitalization. So this is also quite an important thing to be considering, especially with regards to CANSLIM, because you want companies that are leaders. So the L in CANSLIM is for leader or laggard. You want companies which have a large market cap, because this can demonstrate more so that they are a leader. In particular here, what we've done is we've made the market cap greater than 1 billion. So this is quite a small market cap. However, if we set this to be the baseline, then we've still got a lot of other companies available, but we've eliminated the smaller penny stocks. Cash ratio is another ratio which is good to be using. So what we have done here is we have made this greater than 1.2. Again, there isn't really necessarily an ideal figure, but greater than 1.2% is better than, you always need to look back at the industry in particular. Interest coverage ratio. So this is another one which is really good to be using. And again, it varies by industry, but higher is better for this one. In general, we want it to be greater than 2, but greater than 3 is much better. So we want as a basis greater than 2 for our screening, and then we can see later down the line, okay, is it greater than 3? That's even better. So that is, again, what we have done here. So what we have done is we've allocated a few different criteria, and we've used these to screen for our stocks. There are a lot more ratios and a lot more to consider with regards to this. So there are so many different ways to screen for stocks. This is just one example of how we've done it in this case. But at the end of your screening, you still want about 20 to 30 stocks so that you can have a look through and see, okay, which one is a good company, rather than just being left with 1 or 2, and then you might have eliminated some that you might have considered otherwise. It's also important to note that sometimes these screening tools eliminate some companies that you might have otherwise thought to invest in, because sometimes there are things like COVID which have affected companies in a big way. So they have good reasons for why they have, say, a lower EPS change per year. So here are some more examples. We'll be sending out these slides so that you can have a look at these. And this is just a good way to analyze different ratios and use these in your screening if you would prefer to use these rather than the others. So debt to equity ratio is a good one. And another thing to be discussing is Solvency II ratios. So it's important to note that this is for insurance and reinsurance companies. So just for some context, a reinsurance company is a company that insures insurance companies. And this is a good measure to make sure that they can withstand the worst annual loss over the next 200 years if it is greater than 100%. So if you've got an insurance or reinsurance company that is less than 100%, then that's a red flag and you want to avoid it, generally speaking. Dividends. So does anybody know what a dividend is? Okay, so a dividend is a distribution of some of the earnings to shareholders. This is a really great way for companies to be allocating their free cash flow, and the share price reflects that they have the dividends, because it is something that shareholders value greatly, because if you're getting some money back from a company, then you're going to be thinking, okay, well, this is more of a worthy investment. So therefore, analysts believe that the company is more worth investing in, and so the share price would rise. So this is a bit about dividend ratios. We've talked about these before, but these can be used again to screen for stocks. So once you've done your screening, what happens is you can then click on, as you can see back here, at the bottom of this, it's not on the screenshot, unfortunately, but there is a button that you can click to then see the companies that you were looking at. And so, for example, you have this. So here you've got a load of different companies which you can be looking into. You can sort by different things. So here, for example, we've sorted it by market cap, but if you click on some of the others, then you can sort by those. The criteria along the top are the criteria you have used when you have been screening. So for example, if you were to then click on one particular company, so you select the name of the company that you want to look into in more detail. So for example, here, if you select Crocs, then you can find a little bit more detail on it. So there are different functions in Bloomberg that you can use to analyze this. Comparing to peers is a good way to see in terms of L for CANSLIM. So you want to know whether they are a leader in the market, in their industry. So you would want to be comparing to their peers for L in CANSLIM. What you would be clicking on here initially would be security description. So it's number 4, the first one under related functions. And that would bring up this. So there's a lot more research you can do from this. You've now decided that you're going to look into one particular company, and you're doing a little bit more background research to see, okay, is this a good company, or am I just wasting my time? Should I go back to what we had before and have a look at a different company instead? Once you've found a company that you think, okay, this seems to be something that might be a worthy investment, what you would then want to be doing is you would want to be doing a discounted cash flow analysis. So this is point number 3 on your research. Before I proceed, does anyone have any questions? No? Okay, great. So as an example, the Bloomberg Terminal has a discounted cash flow analysis tool, which means that is great because you don't have to do it yourself. It means that then you can find out what the potential upside is in a matter of seconds rather than having to do it all yourself. So as an example, this is Aviva, and this was when I was looking into it around the 28th of February. So as you can see here, there is a potential upside that you can see. Let me see if I can circle it on here so that you can see. So you've got here the current share price, or the share price at the time, and then you've got the consensus price target. So this is the price target by the analysts, what they predict it will go to. And then underneath here we have the DCF, estimated value per share. So here there are two different methods of calculating this. And in both cases, we have a potential upside of above 100%. With potential upsides, it is really important to note that these are not always necessarily that accurate. So if you have a potential upside of, say, 15%, that doesn't necessarily fill you with that much confidence, because 15% potential upside, that means that there could still be a 15% potential downside. Whereas when we have something like 100% potential upside, then that fills us with a lot more confidence because there is more room for error. And then as you can see from here, so this is how Aviva has evolved since then. So this was when we were looking at the potential upside, and this is where it is at now. So it goes to show that something like this is all about value investing. So it is the belief that it will eventually resort to the intrinsic value. So the DCF calculates what you deem to be an intrinsic value for the share price. This is one method of doing it. Again, there are lots of different methods. By looking at both of these and having over 100% for both of these methods here, that fills us with a lot more confidence. When I was looking at other companies at the time, some of them had 300% for one model and then only 50% or 20% for another model. In that case, you begin to question whether the model is really accurate and which model should you be checking, which model would be better. But having both of these supporting a similar percentage, this gives us a lot of confidence, which seemed to work out in the end. So CANSLIM in particular, going back to this, what I was talking about earlier was an economic moat. So what is an economic moat? An economic moat is a competitive advantage for one particular company. So let's say we have a company A and company B wants to come along and do exactly the same thing that company A is doing. What is stopping company B from taking a lot of company A's market cap? So this thing that is preventing it is an economic moat. So there are lots of different types of economic moat. For example, if you think of Nike, you've got the economic moat of the brand. There are a lot of people who really like the brand in particular, and so therefore they would not be as willing to go to another brand. With another point is switching costs. So for example, if you are with Virgin Media and you want to switch to another company, it's going to be A, quite a big hassle for you to switch, and B, there might be a switching cost for you to do so. And this prevents you from going from one company to another. There are also, in terms of when I was talking about Nike, that is, the brand is something intangible. So this is point 3, is intangibles. DCF, so discounted cash flow model. This is what I was talking about a minute ago with Aviva. So the next thing to do is to create a research report. What are you going to be doing with this? So if you're using CANSLIM analysis, CANSLIM is going to come into play with this. First of all, what you want to do is you want to do a company overview. You want to look at the industry itself and have a look at, analyze the industry, analyze whereabouts does the company that you're looking into fit into the industry. This also leads into the leader or laggard part of CANSLIM, so L, as you want to know that they are a company that is a leader in the industry. SWOT analysis is strengths, weaknesses, opportunities, and threats. It's really important to have a look at these because, especially if you're looking at growth stocks, you're wanting to know whether a company, what are its future opportunities? What are the weaknesses that are going to hold it back? It's really good to step back and think, okay, I might be really interested in this company, but what are the weaknesses? What are the red flags that are stopping me from investing in this company? Because as well as looking at the great things of a company, you always need to note the things that might impact the stock price for the worst. Also going back to that, you've got CANSLIM analysis, which I was talking about earlier, and dividends. In terms of further reading, so I was talking about the Bloomberg Markets Market Concepts course in particular. This is a really, really good resource. We really recommend that. And also Intuition now have some courses online. They have one free course for all of the university, and also they have a 40% discount on all of their other courses. Also make sure to get your Financial Times subscription.